What happens when the world's largest borrower, the United States government, starts relying on 1-month loans to fund trillions of dollars in debt? This isn't just a fiscal decision. It's a shockwave that's rippling through the global financial system. In this video, we'll break down one of the most important and underappreciated shifts in today's markets, and why it could change how money moves, how economies function, and how financial power is distributed across the world. You'll understand complex forces like Treasury bill issuance, yield curve distortions, liquidity tightening, and reverse repos, all explained with real-world clarity and simple examples. This is a deeply researched video. Content like this is rare to find, especially in such a clear and digestible format. So, like the video, subscribe to the channel, and stick around till the end, because by the final section, we'll tie everything together and show you how things happening beneath the surface today could redefine the way global finance works tomorrow. Let's start with the big picture. We all know the United States is running a massive budget deficit, nearly $2 trillion for the year. To fund this gap, the Treasury needs to issue a lot of debt. But instead of locking in long-term borrowing at today's rates, it's issuing more short-term debt than usual. In July 2025, this strategy has become especially noticeable. The Treasury is heavily leaning on short-term bills, like 4-week and 13-week Treasury bills, rather than longer-term bonds. Now, this is a big deal because it raises important questions. Why would the world's largest economy choose short-term debt in such volume? What risks does this strategy pose? And how should market participants and decision-makers think about it? Historically, the United States government spreads its borrowing across short, medium, and long-term bonds. Think of it like a company managing its debt maturity profile. A mix helps balance interest costs and refinancing risks. But in 2025, the Treasury is tilting hard towards short-term bills. This isn't just about saving on interest in the short run. It's also driven by market dynamics and immediate cash needs. Short-term debt is cheaper, faster to issue, and more flexible when fiscal uncertainty is high. On the flip side, if you borrow for 10 years, your interest cost is fixed for the long haul, which gives you certainty. But here's the risk for the borrower. If interest rates drop later, you'll still be paying the higher old rate. You're locked in. That's duration risk. You've given up the chance to refinance at cheaper rates. So both choices come with trade-offs. Let's say your company borrows 1 crore rupees for 3 months. After 3 months, you'll have to borrow again to repay that loan. That's rollover risk. The risk that interest rates go up or investors pull back just when you need to refinance. Now let's turn to the charts, because this behavior is visible in real market data. Under normal conditions, short-term yields are lower than long-term yields. A 4-week Treasury bill, which is also called ultra short-term bills, usually yields close to the Fed funds rate, around 4.3%, while a 13-week bill, which is referred as short-term bill, offers slightly more since it ties up your money for longer. But check out this chart. In April 2023 and again in mid-2025, this normal pattern broke down. Look at the blue line. That's the 4-week yield. It plunged sharply in both periods. Why? Because of US debt ceiling concerns. Investors panicked and bought only the very shortest bills that would mature before any potential default. That demand pushed up prices and pulled yields down. Now look at the red line, the 13-week yield. It actually rose at the same time. The usual tiny 3 to 5 basis point gap between these two exploded to over 120 basis points. That massive spike, clearly visible in late March to early May 2023, shows how distorted the market became. The same pattern re-emerged in June and July 2025. Another panic. Another rush into ultra-short bills. So this chart isn't just a technical curiosity. It's a window into investor psychology. A kink in the yield curve tells us when the market sees even a slight chance of default as worth hedging. That fear shows up instantly in how short-term yields behave. Now, you might wonder, why is demand for short-term bills so high, even beyond debt ceiling panic? It's not just fear. It's structural liquidity dynamics. First, The Federal Reserve's reverse repo balances have dropped from over $2.5 trillion to almost zero. That means large institutions aren't parking excess cash at the Fed anymore. Instead, they're moving that money into treasury bills, which offer better returns with similar safety. Second, new regulations around stablecoins and money market funds now require that their reserves be backed by safe, short-term treasuries. That's creating a steady, built-in demand for treasury bills, regardless of yield fluctuations. So even if short-term yields dip occasionally, demand remains strong. And that demand pressure helps keep ultra-short yields firm despite rate expectations shifting. Let's now decode a phrase you've probably heard a lot lately: liquidity tightening. What does it really mean? Simply put, it means there's less cash freely circulating in the financial system. That can happen even without rate hikes. In today's case, it's happening through three channels. 1. The Fed is shrinking reserves, which means banks have less money to lend. 2. Reverse repo balances are falling. Institutions are withdrawing money from the Fed and parking it elsewhere. 3. The Treasury is issuing more short-term debt, which soaks up even more cash from markets. Yes, some of that cash gets recycled into Treasury bills. But overall, there's a net reduction in liquidity, and that makes funding more expensive, especially for private borrowers. In short, even if interest rates are steady, tighter liquidity alone can push up yields. Now let's zoom out. What happens in the United States doesn't stay in the United States, especially when it comes to short-term rates. When US short-term yields, like 3-month or 6-month bills, stay elevated, they attract capital from around the world. Investors in Europe, Asia, and the Middle East shift their money into US assets. That demand strengthens the dollar. But a stronger dollar has ripple effects. It makes it more expensive for foreign borrowers to repay dollar-denominated debt. It also pushes commodity prices lower, pressures emerging markets, and can even influence other central banks' policy choices. So, the Treasury's borrowing strategy, while focused on domestic funding, ends up impacting global capital flows, currency markets, and financial conditions far beyond the United States. Here's the key takeaway. The US Treasury is betting on ultra-short-term borrowing to save costs today. But that decision brings a trade-off: more frequent refinancing and exposure to future volatility. And this shift isn't happening in isolation. It's unfolding while the Fed is scaling back its support, investors are growing cautious, and global demand for treasury bills is changing shape. Even if rate cuts come, short-term yields might not fall as much, not because of policy, but because of sheer supply, structural demand, and liquidity mechanics. Yes, institutional money is moving out of the Fed and into treasury bills. But that doesn't automatically stabilize markets when everyone's watching yield levels, rollover timelines, and debt ceiling debates. In short, today's cost saving could become tomorrow's market risk, and the yield curve is where that risk first shows up. If you found this breakdown useful, don't forget to like and subscribe. We're here to simplify complex market narratives and give you the edge to think sharper, invest better, and stay ahead. See you in the next one.